The financial world is currently split into two distinct realities. In the first reality, retail investors are staring at 1-hour candles, paralyzed by sideways price action and drowning in the noise of social media pundits. In the second reality, the global banking elite is quietly finalizing the blueprints for the greatest infrastructure migration in the history of money. While the crowd is looking for a pump, the institutions are looking for a bridge. Welcome to Crypto Report. This is the space where we ignore the emotional swings of the market and focus strictly on the structural architecture of the new global financial system. Today, we are deconstructing the reality of Ripple's banking strategy, a strategy that is finally starting to unfold in plain sight. For years, a popular narrative suggested that Ripple was an outsider trying to defeat the legacy banking system. This was the great misdirection. The clinical truth is far more profound. Ripple was never designed to destroy the banks. It was designed to become their indispensable plumbing. We are witnessing the institutional coronation of an asset that was engineered to rule the rails, not replace them. To understand why this is happening now, you have to understand the fundamental math of the correspondent banking crisis. Right now, there is an estimated $27 trillion trapped in dormant Nostro and Vostro accounts around the world. These are massive pools of capital that sit idle just to ensure that a bank in New York can settle a payment with a bank in Tokyo. This capital is non-productive. It generates no yield. In a world of rising interest rates and tightening liquidity, the banking sector can no longer afford to let $27 trillion sit in the dark. This is where the Ripple strategy moves from theory to mandatory implementation. Ripple's Liquidity Hub and the XRP Ledger do not just offer a faster way to send money. They offer a way to delete the need for pre-funded accounts entirely. By using XRP as a bridge asset, a bank can move value in 3 seconds, settling the transaction instantly and freeing up billions of dollars in liquidity that was previously trapped. We are not talking about a maybe scenario. We are watching the clinical execution of a plan that has been in the works for a decade. The central banks are not looking for a speculative asset to gamble on. They are looking for a neutral, decentralized, and highly liquid settlement layer that functions with the precision of a Swiss watch. The era of the con narrative is over. The era of the institutional utility of XRP has officially begun. The institutions that once mocked this technology are now the ones welding it into their core architecture. They aren't announcing it on Twitter because they are still in the accumulation phase. They are building the on-ramps while the retail crowd is distracted by the exit sign. In the following sections, we will break down how this integration is happening through the very systems you've been told were Ripple's competitors. To understand the magnitude of what is unfolding, we have to dismantle one of the most persistent myths in the digital asset space: the idea that Ripple is here to kill Swift. This is a retail fantasy that misses the clinical, institutional reality. The banking world does not operate on a winner-take-all philosophy. It operates on the concept of interoperability and redundancy. The strategy Ripple is executing is far more sophisticated than a simple replacement. They are building a layered stack. Swift is a messaging system. It is the email of the banking world. It tells Bank A that Bank B wants to move money, but it does not move the actual value. The settlement, the actual movement of the liquid capital, is where the friction, the costs, and the multi-day delays occur. Ripple's strategy is to integrate the XRP ledger as the settlement layer that sits directly underneath the Swift messaging protocol. This isn't a theory, it's a technical evolution. We are moving toward a multi-rail reality where a bank can send a message via Swift, but the value is routed through the XRP ledger because the ledger is mathematically the path of least resistance. Think about how your computer connects to the internet. You don't care if the data travels over fiber optics, satellite, or copper wire. You only care that the data arrives instantly. Banks are moving toward this same agnostic routing. When a cross-border payment is triggered, the automated systems of the future will scan the available rails. They will look at the cost of pre-funding a Nostro account versus the cost of a 3-second XRP settlement. The math will win every single time. This is why we see quiet, clinical moves from entities like SBI Holdings in Japan and Cross River Bank in the United States. These institutions aren't just testing the tech. They are integrating Ripple's API into their core banking software. They are preparing for a world where the ledger is the default engine for high-velocity payments. Furthermore, we must look at the role of prime brokerages and liquidity providers. For XRP to function as the global bridge, it requires deep, institutional-grade liquidity. This is why Ripple has been aggressively acquiring companies like Medico and Standard Custody. They are building the bank of banks. They are creating the regulated, secure environment that allows a Tier 1 bank to hold and move XRP without taking on the typical risks associated with the Wild West crypto markets. The Swift versus Ripple debate is a distraction for the uninformed. The real story is the integration of the XRP ledger into the global financial plumbing. While the media focuses on whether Swift is adopting blockchain, the reality is that the plumbing is already being laid. The pipes are being connected. When the switch is finally flipped, the volume won't come from retail traders buying and selling on exchanges. It will come from the automated, programmatic routing of global commerce through the ledger. We are talking about trillions of dollars in volume that will be price agnostic. A bank doesn't care if XRP is 50 cents or $500. In fact, for the system to handle the sheer scale of global trade, a higher price is a structural necessity. You cannot move $1 billion through a bridge that only has $1 million of capacity. The higher the price of the bridge asset, the more weight the bridge can carry. This is the institutional math that the retail crowd consistently ignores. As we move deeper into the architecture, we have to look at the sovereign checkmate. While the world was distracted by the SEC lawsuit, Ripple was busy securing the regulatory and technical licenses to function as a national trust bank. The goal is clear: the Fed master account. This isn't just about a private company moving money. It is about providing a sovereign-grade environment where central banks and commercial giants can operate with absolute legal certainty. Enter RLUSD, Ripple's strategic stablecoin engine. To the uninitiated, RLUSD might look like just another competitor to USDT or USDC. But in the clinical context of banking, it is a surgical tool. Banks are inherently conservative. They require a stable, compliant, and U.S. Treasury-backed digital dollar to act as the stable leg of a transaction. RLUSD provides that stability. It creates a massive mandatory demand for U.S. debt, which aligns Ripple's interests directly with the U.S. Treasury. But here is the structural secret that most people miss. RLUSD and XRP are not competitors. They are a symbiotic pair. RLUSD is the vehicle for domestic stability and internal bank accounting, while XRP is the high-velocity, neutral bridge asset for cross-border liquidity. You use RLUSD to hold value safely on the ledger, and you use XRP to teleport that value across the planet in 3 seconds. By launching RLUSD, Ripple has effectively turned the XRP ledger into a one-stop shop for institutional finance. A bank can now stay entirely within the Ripple ecosystem, using RLUSD for its dollar-denominated reserves and XRP for its global settlement needs. This creates a bank of banks infrastructure. Through multi-billion-dollar acquisitions like Medico and standard custody, Ripple has positioned itself to provide institutional-grade custody, clearing, and financing. They didn't just build a coin, they built the entire bank of the future. The Clarity Act, with its expected passage near the March 1st deadline, acts as the mass adoption switch. For the first time, there is a hard deadline. The world is moving forward, and the US has realized it can no longer afford to slow down the inevitable. The institutions are entering this space for one reason: to capture the $13 trillion institutional tide that is finally being funneled through the Ripple Treasury rails. If you are finding value in this deep dive into the structural mechanics of the market, make sure to subscribe to Crypto Report. We don't do hype, we do data. We analyze the signals that the 99.99% are too busy to see because they are distracted by daily noise. Only those who understand the clinical math of the retirement discovery ladder will reach the finish line. One of the greatest obstacles to understanding the true potential of XRP is the traditional retail view of market cap. Most investors look at the current market cap and compare it to the total supply of 100 billion tokens, concluding that a high price is impossible. This is a fundamental misunderstanding of institutional mechanics. In the world of global banking, a high price for XRP isn't just a fantasy, it is a structural requirement. To understand why, we have to perform a clinical breakdown of the liquidity squeeze. For XRP to function as the bridge for trillions of dollars in daily cross-border payments, it must have deep liquid capacity. If a bank needs to move $1 billion in a single transaction, and the price of XRP is only $1, that single transaction would require 1 billion tokens. This would cause massive slippage and exhaust the available liquidity on the ledger. However, if the price of XRP is $100, that same $1 billion transaction only requires 10 million tokens. If the price is $1,000, it only requires 1 million tokens. The higher the price, the more value the ledger can move with less friction. Banks and central banks are not looking for a cheap asset. They are looking for an efficient asset. A high XRP price is what allows the flywheel of global settlement to turn without grinding to a halt. Now, look at the supply side of the equation. We are seeing a historic contraction in liquid supply. Institutional cold storage is sucking XRP out of the open market at an unprecedented rate. Exchange reserves are hitting multi-year lows. Major players like BlackRock and Franklin Templeton are moving into the tokenization space, eyeing the XRP ledger as a primary host for real-world assets. When you combine fixed supply with an automated transaction burn and massive institutional lockups, you create a supply-side shock. The multiplier effect occurs when this shrinking supply meets price-agnostic demand. When a bank's automated routing system triggers a $500 million settlement, it doesn't limit order its way into the market. It buys at whatever the market price is to ensure the transaction clears in 3 seconds. This is institutional price discovery. It is not driven by retail hype or FOMO. It is driven by the clinical, non-negotiable need for settlement liquidity. We are currently witnessing the expansion of the XRP utility map. Yet 99% of the crowd is still focused on the con narrative. They are looking at the price on their screen, while the institutions are looking at the capacity of the pipes. The price discovery ladder, from $100 to $500 to $1,000 and beyond, is a mathematical journey defined by the total volume of global trade that is funneled through these rails. The data suggests that by the time the retail crowd realizes the market cap argument was a myth, the institutional coronation will be complete. You aren't buying a coin to sell to someone else later. You are buying a piece of the future global payment infrastructure. The math doesn't lie, and the math says that the current liquidity squeeze is the precursor to the greatest upward repricing in financial history. The convergence of these structural forces is leading us to a single, inevitable point in time. We are no longer speculating on if Ripple's strategy will unfold. We are mapping out the when. The timeline is being dictated by three massive pillars: regulatory finality, the tokenization wave, and the desperate need for banking yield. First, the regulatory gates are swinging open. With the anticipated implementation of the Clarity Act and the global shift toward the ISO 20022 standard, the legal uncertainty that once acted as a barrier for Tier 1 banks has been vaporized. This isn't just a win for Ripple, it is a mandate for the entire banking sector. Any institution that fails to adopt high-velocity settlement rails will find itself unable to compete in a T+0 world. The 90-day window we are entering is the final transition from the testing phase to the implementation phase. Second, we must look at the tokenization of real-world assets, RWA. Giants like BlackRock and Franklin Templeton have already signaled that the future of finance is on-chain. We are talking about hundreds of trillions of dollars in stocks, bonds, and real estate being digitized. These assets will require a specialized, institutional-grade ledger for movement and settlement. The XRP ledger was built specifically for this type of heavy lifting. When the world's wealth begins to move across these rails, the demand for XRP as the neutral bridge will reach escape velocity. Finally, we have the yield crisis. In a tightening global economy, banks can no longer leave trillions of dollars sitting in stagnant nostro accounts. They need that capital to work. By adopting XRP, they free up that $27 trillion in dead money, allowing them to reinvest it into yield-bearing products. The move to Ripple isn't just about saving on fees. It's a massive capital efficiency play that adds billions to a bank's bottom line. The verdict is clear. The retail crowd is frustrated by the horizontal price action, but the institutional data shows long-only accumulation and structural validation. The signals are coming from Visa, from Bloomberg, from the Japanese financial framework, and from the inner circles of the US Treasury. They all point to the same conclusion. The plumbing is finished. The coronation is here. Don't be distracted by the daily noise or the con narratives designed to shake you out of your position. Understand the clinical math of the system being built. We are watching the birth of the new global settlement engine. This is Crypto Report. We don't trade the candles, we trade the architecture. Stay rational, stay structural, and we will see you in the next one.